Welcome to VCTV. First of all, happy Monday. I mean, this is the first day of the week, and we are back on VCTV, which is the Venture Capital TV from La Token. And we start our week on VCTV on another new topic for the session for this episode of VCTV, and it's called late stage investment. So welcome everyone, and I'm very excited to have you all. Today I have my co-moderator of the episode, Nathan. Hi Nathan, welcome to VCTV as well. Okay, so he's there. Okay, so before I start introducing my speakers, let me introduce myself. My name is Sonny Mohanty. I'm the regional director of La Token based here in Singapore. I host VCTV Monday to Friday, 8 p.m. Singapore time. So a little bit about VCTV. VCTV is a platform where we connect investors with founders. VCTV started in 2020 March because of the pandemic. We couldn't travel around the world doing our road shows called Blockchain Economic Forum. So La Token is very much known by Blockchain Economic Forum, where we get investors and startups under one roof. So because of the pandemic, we moved everything online, and that's what it's called, VCTV. And ever since then, we've been successfully running VCTV. Our investor base, our founder base, startup base has grown tenfold since last year. So today we're discussing a very interesting topic about late stage investing. Little bit background about late stage investing before I start with questions, open up the floor for questions and answers. So late stage investing supports companies that are moved beyond the startup phase of development and have rapid growing sales, or have fast growth potential. If early stage venture is about asking what if it works, late stage venture is also about asking, is it going to work? Is it working? Is it working actually? And just as early stage investing requires deep vertical expertise, later stage venture requires deep expertise in the financial evaluation of businesses. So yeah, early stage is about what if it works, and late stage is about is it working. So let's talk about late stage startups, late stage investing, some of the best metrics followed in investing in late stage startups. So I'm going to start with our new speakers. We have two speakers who are new to VCTV. Let's start with them. One from Hong Kong, another from UK. So I'm going to start with John. Hi, John. Welcome to VCTV. Let's start with your introduction and your background about of you, please. Thank you.
Sure. Thank you for having me today. I'm the founder and partner of Voyager Capital, and we're SFC licensed investment advisory and asset management firm based in Hong Kong. We primarily invest in growth stage and late stage AI and enterprise SaaS companies. We advise family offices, high net worth individuals, and financial institutions on venture investing. Last year alone, together with our clients, we made over 20 million in investments. And we look for companies with exceptional teams, proven business models, and impactful applications of technologies.
Excellent. And you mostly invest into growth stage and late stage, right?
That's right.
Okay, correct. And welcome to VCTV. Thank you so much. We just had a discussion before we went live. Thank you, John, for that. And let's move on to our next new speaker of the episode, David Marshall from UK. Hi, David. Welcome to VCTV. And happy Monday. How are things back in UK, and how are you today?
Yeah, thank you, Sonny, for having me on. It's a real pleasure to be here and be in such a good company. The UK is very grey and cold, as per usual this time of year, unfortunately. So we're struggling through, obviously, with some of the challenges that we're facing with COVID, as we all know, in different places, and the UK seems to be struggling a little bit more than most, unfortunately. So we're in a pretty deep lockdown here, but nonetheless, we're still extremely busy in terms of opportunity and client opportunities in particular. A little bit of background about myself. I was a fund manager for almost 10 years, worked overseas. We had a core focus in those days around what we would now know as the FANG stocks. So working with a lot of these early start companies and then helping to do follow-up raises through institutional-led private placements. That's something I continue to do today. We invest in around 12 to 15 of these types of projects, which is interesting because, you know, it's where you move from the kind of very entrepreneurial risk-taking appetite of a startup to where you start bringing in accountants, you know, and professional people to create EBITDAs and you know, profit registers and just really show the value of how the growth of that company can be sustained, and that's really around where you start looking at secondary and third investments from larger funds that looking, you know, they have much larger capital to deploy, and they're not looking to invest in, you know, 100 projects a year. They're looking to invest in 1 or 2 of those, but really make sure that they're impactful because they need to put a lot of money to play. So a little bit more about myself. Currently, I got more involved in the crypto ecosystem some years back because there was so much clamor for people within the traditional space for wanting exposure to it. So a number of years ago, we created a crypto-centric fund called Zero Capital. We invested in around $100 million over a 2-year period in about 50 different projects. And so that was quite early stage, as you can imagine. We've since kind of like moved more into incubating through TDFi and through other venture capital funds. And we tend to lead a lot of these rounds with the main focus around helping at that very early stage, but then with a more focus to develop them towards the latter stage. So this year and next year, we're really focused on actually taking some of these projects to a legacy listing in the traditional market. So that's quite fascinating. And I think that's going to be a theme of the next 2 to 3 years, in fact.
Yeah, that's fascinating. Crypto fund. I mean, I've seen a lot of crypto funds over the last year. I mean, obviously very new. So David, this fund is only UK focused, or you also invest into blockchain startups in other parts of the world as well?
Yeah, it's an international global focus. I think as all of the people on here, you know, the focus for us is really around 3 things. It's potentially groundbreaking technologies in whatever sector that might be. Obviously, DeFi is a big focus right now, and outside of that, it's around the people too. So if you have great ideas, great people, and great connections, you know, they're the 3 kind of pillars to success. And sometimes you're not always getting all of those, so it's kind of fitting the right people into the right project, to the right project, to the right people, and that's really where the incubation comes in. Yeah.
Absolutely. Thank you so much for that introduction, David, and welcome to BCTV. We're going to have you more on the episodes. Next, I have Dr. Srikanth from India, who's just joined us again. Hi, Dr. Srikanth. How are you today? Please help introduce yourself with some background, please. Thank you.
Thank you very much. I too work with family offices, John. I work with the Forbes 500 here in India as a legal counsel as well as a legal representative. I also help manage their wealth. A bit of a background, I am a chartered accountant, a chartered manager coming from UK. I worked in India, Singapore, Hong Kong. Hong Kong is where I had my baby, so Hong Kong is very close to my heart. So when I see the background of John, I'm very moved by that particular background. And UK is where I studied. So you know, I have both these countries being represented today, and it is a pleasure. So let me, as we talk, we'll get into the perspective of the India story of late stage investing. So looking forward to the great panel.
Excellent. Good to know about the baby and UK experience. And welcome back, Srikanth, Dr. Srikanth, to VCTV. Fantastic. And last but not least, we have Gary. Gary, hi, welcome back on
Hello, how are you
Hi.
today?
I am very good indeed. Thank you so much for asking.
Great to be here. So my name is Gary Fowler. I'm a investor and a serial entrepreneur. I've done 17 companies, 2 unicorns. I was involved in the original management team of Click Software, which was sold to Salesforce for 1.35 billion, and also Yva.ai, company I started 4.5 years ago. Man, time flies, actually. It's hard to believe. But with David Yang, I founded that company in Silicon Valley. We are Silicon Valley based, and we believe that Silicon Valley is a port to the rest of the world. So we curate companies. My company today is GSD, Get Shit Done Venture Studios, and we're looking for AI companies everywhere to use Silicon Valley as a port to get them out to the world. I write a lot. I've written 112 articles now in the last year. Every week I'm adding more and more and more. And the ones that fall off because we're writing so many more, I'm writing about cognitive computing, cloud computing, quantum computing, and the quantum internet right now.
Wow, great. Welcome back, Gary, on VCTV. Perfect. We are all set for with the introductions of our speakers. I have many questions on this topic, basically, and I'm sure all our speakers are from the background to share their insights today. So the collapse of WeWork IPO, we all know that, and the disappointing listings of Uber and Lyft from the internet. So have forced the late stage investors to reconsider the metrics of investing. So this is something I had to open up the floor to with introduction, because what went wrong with WeWork? We'd like to obviously let our startups know that what metrics should be followed, lessons learned. So let's start with John. Over to you, please, John, with your opening remarks about this topic, because you have deep expertise in investing into startups in the growth stage and the late stage and the IPO. Those who are moving into an IPO. So over to you.
Well, thanks, Sonny. I think that for us, what's most important when we look at late stage investing or investing companies in general are the founders, the business model, and the technology. So before WeWork went public for IPO, a billionaire came to me and asked me what I thought of investing in WeWork. And I felt that the management, the founder himself, was kind of eccentric, and he had special abilities in managing building companies. But I didn't feel comfortable because his style wasn't wasn't familiar to me. And when I thought about the business model, I actually went to WeWork spaces in Hong Kong, and I felt that it was quite empty, and I started to fear for them. So when time came and people asked me whether I wanted to invest in WeWork, I politely declined. And we've seen. And over the years, we've learned that it's about going back to common sense. Is this a viable business model in the long run? And are the founders responsible for money? That we also just had an IPO that didn't go through in China, which was Ant Financial, and a lot of family offices around the world wanted to get into the game. But when we looked at it, we realized that there was very murky activities going on. And we realized that there was very little information. It was not any regular IPO. So we declined it very, very early. And I think that it's about finding the right strategy and finding the right deals that fit your strategy, and not just following the herd. That would be my advice for late stage investing into pre-IPO deals.
I think SoftBank should have done, WeWork is a big, So when you said that you were invited to invest in WeWork, which year was this? When are we talking about? Which year was that?
Actually, twice. I think once in 2015, and the last time I think was a year or two ago.
Is because you turned down the offer is because you didn't sync with the vision of the founder. Am I correct?
We didn't feel that what the founder, we didn't resonate with the founder's style. Nor did we fully agree with the business model. And when we looked at their products in Hong Kong, I mean, for us, user experience and is very important, but also it needs to be a viable business model. And when we visited the WeWork offices in Hong Kong, I mean, they weren't fully occupied to the extent that we had expected. So, and we looked at the users, and we decided, and we realized that that was not the right model. And we were worried that they had so many contracts signed, but the financials must be suffering. So we decided not to proceed.
Right. So great points, great start, Johnson. Really a very good start for this show today and the topic. Next, I'd like to go Shrikant, because obviously let's start with Asia, then move to UK, and then let's go Florida. Shrikant, obviously we started on WeWork IPO, and Johnson was invited to invest, and he didn't invest in 2015 and 2 years back because of the obvious reasons he just shared with us. And we know that WeWork IPO was a failure. So let's start with your insights from the India market, from the India perspective.
Sorry, a bit of a technical glitch over here. So in India, it is a different story altogether, and John would agree, or people who are closely looking at India as a market would agree. So 2016 is when we had a wave of startups, right? The big shift happened in 2016, where we had demonetization, a policy shift from the government, and there was a lot of investment in the startups. And these term sheets which were signed in 2016 came with a clause that they would go for a public listing in 2021, which is the five-year period. And we all know 2020 has been a washout year. So the IPO period has been pushed even further to possibly 2023. And in India, to list, you need a solid 2-year runway, right? So a late stage investing used to be a very in thing in 2019. As a matter of fact, we vetted almost 65 term sheets in 2019, which did not assume fruition in 2020, primarily because of the fact that there was lockdown, term sheets were not honored, and so on and so forth. And of course, as lawyers, we also argue on the other side as to whether these term sheets have to be enforced and so on and so forth. It's good business for us. I'm live on TV, and I don't know if I should be saying this. So that being said, 2023 it turns out to be a very good year. Apparently, and if you see the unicorns of India, the so-called or unicorns of India, especially in the FMCG, especially in the F&B, food and beverage, especially in tangible products, consumer products, which rode the COVID wave as such, thinking of a listing in 2022. But mind you, a listing is a very, very different animal altogether here in India. And the price fluctuations which happen are you have something called a circuit breaker, where even if there's a 5% change in the price, there is the stocks will not be traded at all. So if I may take 30 more seconds, it's a bit complicated in India, primarily because of the fact that if you do a small board listing, you need to have a minimum lot size of 1 lakh or 100,000 units, which gives rise to the possibility of illiquidity for small stocks. At the same time, no incentive for small stocks to actually get listed. So late stage investing would turn out to be not a pre-IPO listing. It would be late stage, but a pre-PE takeover is something that I've seen as a trend emerging out of India. I don't know if
what was that pre-PE takeover?
late stage investing necessarily need not be pre-IPO. It is turning out to be pre-takeover. So you have takeover wave, which is actually happening here in India. So I'm part of certain takeover waves which are happening. So I don't think listing is an option, but that is not the only option that that family offices are also looking at.
Right. So it's a merger and acquisition before a pre-IPO or IPO in India. Thank you so much, Dr. Shrikant. Next, I have David. Hi, David. What's your insights about investing, especially into late-stage startups?
Yeah, thank you. Well, I mean, there's so many things you can go into, but I mean, from my experience, the biggest challenge when you're looking at investments is really trying to understand the team and what kind of experience they have or don't have, what good advisors they have. One of the biggest issues you typically find with startups is they're usually run by very hungry, risk-taking appetite type of people. And you need that. You can't have conservative people running businesses typically in startups. But one thing we all know about business, it's constantly changing. And so you have to have, in my opinion, that happy mix between being able to be in love with your baby, which most entrepreneurs are obsessed and completely passionate about their company, but they have to have some understanding that they need to let go some of those reins at some point and bring in people that have been there and done that and have the wisdom of experience. That's the biggest challenge with most of these companies. If they don't bring people in, if they don't have people there that have been through the experience of actually failing as well, you know, I always slightly worry when someone's never failed at anything because they don't know how to react when things get tough. And at some stage, it will always get tough. So the big thing for me, and I think it's a bit of a cliche, but it's absolutely apparent, is the team is so important. You know, the experience, the people behind that. You know, I was listening to what Gary was saying. You know, Gary's been there, done it. You know, he's invested in all these different companies. It wouldn't matter how much success somebody's had if they haven't had some experiences, and in particular, bad experiences. One of the best experiences of my life was losing millions of dollars. I hated it at the time, but it taught me a valuable lesson because until that point, I thought I was untouchable. And so for me, it's really understanding in business, you expect the product to be good. You expect the revenues to be there. These are prerequisites, but you have to have a team that understands that they need to adapt to the next change. And I would imagine, looking at the example you guys made, you know, there was an entrepreneur, you know, he didn't want to change. He didn't want to adapt. He wasn't prepared to make the sacrifices to take this to the next level. And I see that even today. There was a company, I won't mention the name, but a very, very successful private company based out of Canada that were doing $20 million plus revenues. And they closed the operations down to get a license. So they were in the cannabis industry. And it was young guys, extremely aggressive, fantastic sales guys, you know, very, very entrepreneurial spirit. But they did not listen to the experts, people's advice. And it took 18 months for that company to become listed. And they're suffering now because of poor performance in the aftermarket, because people got frustrated, irrespective of the fact that they, you know, have a good product and they're making money. And so this is so crucial. For me, it's always about the people behind them. Are they prepared to adapt? That's the fundamental rule for me.
Right. Very interesting perspectives, David, with an practical use case coming from Canada after WeWork and financial. I think John is going to talk about it later more before Gary. Gary, over to you with some interesting insights coming about this late stage investing on startups, please. Thank you so much.
Yes, absolutely. So, you know, I've done a Nasdaq IPO. We've been through mergers and acquisition. but it's a keep it simple, stupid. I mean, I'm a country boy, as I've said, from Pennsylvania, grew up on a farm, 500 people in a village. So as I said before, if it's black and white and it has horns, it's probably a cow. So simple, simple stuff. And that's the name of my company, GSD, Get Shit Done. Came from Zuckerberg's office, by the way. So let's look at what we have. So it's right. It's David was talking about the team. Teams are incredibly important. I mean, that's it. The ability to be able to pivot in critical times. So my partner in Yva.ai is David Yang, a billionaire from Russia. Actually, we started a company. We're in Silicon Valley. Normally, I'm in Silicon Valley. I just happen to be at my house in Palm Beach right now, riding out COVID. And anyhow, so it is about being able to pivot. It is about customer development. I went through the same situation early on. I was doing a construction tech company, had built 27 houses. I was 23, 24 years old, and I didn't listen to my customers. I just didn't listen. It cost me $1 million and 3 years worth of, I didn't fail, but a lot of pain. It was like falling off your bike going down a hill. It wasn't fun. I got back up, got on the bike. So you have to also understand where you fit. I fit into a Series A, Series B type environment. After that, when you start having meetings about meetings, it doesn't work. So at GSD, at our venture studio, what we do is we curate those companies. I'm into artificial intelligence, happens to be machine learning, deep learning, which will affect all aspects of our lives, literally all aspects. And I'm also into quantum computing. So we take it through a Series A through Series B. We understand that there are other teams that can come in, and I have no problem because guess what? I still own parts of the company. So for me, and I just did a very large investment in a very interesting space tech company last week on my own personal side. So, of course, I look at the team. I do some research to make sure I don't get into a situation where I'm not comfortable, like a WeWork situation, of course, every time. But the other thing is you gotta make sure you're looking at the positive. And if you're too cautious, you're never going to make any money. It just doesn't work, because there is something about being a maverick out there to be successful. And I've done 17 companies. I started the first accelerator in Russia as an American. Can you imagine going to Moscow and dropping into Moscow and like, who are you? What are you doing? I didn't speak Russian at the time. And I created that over a 14-year period of time. It's now the most successful accelerator in Russia. And I started the #1 private corporate accelerator. Again, people said, oh, you can't do it. But, it's a matter of believing that you can. I did a TED Talk, and it's called POV, Passion, Optimism, and Visualization. And those soft skills of being an entrepreneur are critically important. I look for those kind of things. I look for flexibility in teams. I call it the rule of threes. I get 3 advisors on a team. I look for somebody that's top in security, like the former chief security officer of Apple, Rick Orloff. I look for somebody that's got name brand recognition, like a Guy Kawasaki or Bill Reichert out of the Valley, who are friends, right? And the third thing is I look for somebody that's just had a recent success. This is for the board of advisors. And what I'm doing is I want to make sure that the team itself is balanced. So I look for somebody that's a creative person and visionary, and that's where I come in. But then I always have an operations person that can really back up the stuff that I come out with. So I look for a partner that's got that expertise, and I look for a third of somebody that's deep in technology. Always want to build balanced teams. And I found, for me personally, it works. And so then I look for cutting edge areas. What is really hot? Well, we know data, as we've talked about before, Sonny, is critically important because we're inundated. We are a state of infobesity, 40 zettabytes of data, enough to go to the moon if we had CDs stacked end on end 29 times. So this is like, keep it simple, right? You got a lot of data. You can't make sense of it. Each one of us have a challenge every week with our email saying, I know the file exists, but I can't find it. Why? I've either forgotten the key location or the location or the words. This is simple. So focus on areas where there's pain.
Yeah.
And, those are my rules. Keep it simple. But guess what? It works every single time. When I started Yva from nothing, now we've got a unicorn. When we started Click Software, a company from Israel, right? It was called IET. I renamed it Click Software, and the rest is history. Build relationships with folks too, all over the world. Those relationships today, especially during the pandemic, are critically important because trust is key.
Absolutely. Thank you so much, Gary, bringing so much experience and expertise to BCTV. It's about people. It's about keeping things simple, if I understand as a summary. And so just a quick question. I'm just intrigued. After Series B, does things get complicated in the sense meetings after meetings? So do you think we're now going to see many Series C and D and beyond
No,
startups?
I'm just saying for me, it's not what I'm passionate about. I like to curate the companies. I'm really, really good at getting them in my team, getting them to a Series B, sometimes a Series C. But I understand that I look for people that can fill in, that have skills that are better than skills that I have, to be able to come into the company to take it to the next level. My friend Bob Dorff and Steve Blank wrote a book called The Owner's Startup Manual. And so most startup founders don't survive a company after 150 people because it's a different kind of skill set, right? If you looked at Harvard University, had the first MBA in the world. The MBA was developed to teach managers how to manage, not how to become a startup. I look for those people that have those kind of MBAs to be able to run a company going forward, domain experts, some recognition, et cetera, to take the companies to the next level. And if you find entrepreneurs that are too locked in, there aren't many Mark Zuckerbergs of the world, right, or Steve Jobs. So if you find people that are too locked in, I don't invest in them because I know that the company's going to shift. And if they don't want to adapt to change, it's not worth working with them.
Absolutely. Yeah. I have to pivot. Pandemic has taught us that. Thank you so much, Gary. I'd like to pass the floor to my co-moderator. Nathaniel, are you available?
Yes, I am, guys.
Okay, over to you.
Good day, everyone. So I got a bit of what everybody had to say. Johnson mentioned how he didn't feel comfortable working with the founder of WeWork. David mentioned something about the team. Dr. Shrikant too also mentioned something about people. And I see that Gary too mentioned something about balancing the teams. In all this, it's all about the people, the people, the people. So in my head, I'm trying to figure out what are the traits of the right kind of people that should run a team that you will be satisfied with. Because yes, I understand Gary would like to, would not be involved in the meetings and the day-to-days and back and forth. So what's the right balance? What would you say is the right balance of the qualities of the person before?
So let me, Nathaniel, I want to clarify. I'm not saying I don't get involved in meetings. I get deep in meetings. I can be a micromanager. I'm just saying past the Series B, Series C, it's not as interesting for me personally. I stay involved as an advisor or on the board, but for me to be operationally involved in a company, I generally don't, it's not what I like, right? So that's personal. And the situation, right, it's not what I personally like. It's not that interesting. I'd rather have a Stanford MBA or somebody from Oxford or Harvard, or somebody else. But at the same time, I understand those are areas that are important for me. And I look for entrepreneurs that are flexible, just like David said, just like Johnson said, just as Shrikant said. You want to look for traits where people that are aggressive, but understand that, if somebody has other capabilities that you don't, bring them into the team.
Great. Aggressive and flexible. I got that. Johnson, what would you say?
I would say that I look for a track record of taking on extremely difficult projects and sometimes succeeding, sometimes failing, as David said. I'll use an example of a startup that a late stage startup that we invested in. The founder was 27 years old when we invested in him, but he sounded like he had, he was very mature in his business acumen. He went to Princeton. Well, first he joined the Obama campaign when it was really small, and then took Obama to the White House with the campaign. And then he was elected an official. He was elected as an official in Maryland before he went to college. Then he went to Princeton and did computer science and political science at the same time, and he started his own startup. So I look at that and say, there's a history of performing, of getting shit done, as Gary mentioned. Mm-hmm. And I think that I like that kind of person with that kind of drive, with that kind of aggressiveness, and with the ability to solve challenges and solve problems. I like that very much. But also, I think that gradually, I've also realized that it's important to be able to present yourself to investors and to have a wide network and to be able to be resourceful and talk to investors and be presentable. I think that the stereotypical introvert computer programmer who can only code is very limited. I think that for a company to go from Series B to IPO, you need someone at the helm who's able to present the company and to present a vision to not only its employees, but to investors, global fund managers and investors as well. And that was what I saw in Tim Huang, who is the CEO and founder of Fiscal Note.
Okay, great. That's wonderful. Aggressive, resourceful, and dynamic. So what do you think, Dr. Srikanth? Yeah.
So let us contextualize this particular dialogue over here. We are talking about the time between Series B and potential exit, right? Which could be an IPO or which could be a takeover. So what typically happens is the person who makes a very large round in a company typically gets to have certain directors in the company. So there is a flow or a management of the company which happens before a fundraise happens in that particular company. Then there is a management after fundraise. So the before and after, the kind of pivot that you see, it's a pivot not only pivoting from a business perspective, but also a pivot from a management perspective. So that's a very important pivot, because many a times when you talk about pivoting, we ignore the pivot of the management, right? And especially when the investors get in and they have their own setup and they have their own, the politics and so on and so forth comes in. So I believe an investor who agrees or who sees eye to eye with a particular company should not have a problem post investment, because then the management would be a very smooth management going forward. So the trades that I see in a particular investment is whether I'll be able to work with that particular team, whether the company needs to pivot for the likes and dislikes of mine, or should I pivot for the company if I'm an investor? So I think that is a very crucial question that I ask myself before investing. And that's a question that your investor should be asking you, and you should be asking your investor without hesitation.
Great. Okay, so before I hand over to Sonny, David, what do you think?
So I don't want to go over... Yeah, I don't want to go over what other people have said, because I think, it's been said. So I'll try and add some other insights. So self-awareness is the biggest challenge any of us have. Most of us have poor self-awareness, and it's not our own fault. It's just that we have limited experience. And that comes, unfortunately, with age in some respects, but also it's inherent who you are. I think going to what Gary was saying, right? He knows who he is, and he gets out of his own way. So when he finds himself in a situation through the evolution of a company that he might be, quite early on and part of that kind of really early aggressive growth stage, he knows when to encourage those people and himself. He's already said, like, I'm passionate about these areas. Once it gets to that next kind of very corporate level where you're bringing in lots of middle management and all these other different layers, maybe he's not so interested in that. but you know, he'll sit there on the board, right? Maybe as a non-exec or whatever it might be, and help give advice. And I think that's the thing for me. You know, I look at so many companies that have been successful because there's certain ingredients. I mean, this is not rocket science. You don't have to change the world every single time. You know, as Mark Twain once said, there's no such thing as a new idea, just a reshaping of that old concept. And so technology is a really interesting dynamic because we're being excited constantly by changes and evolution. But when it comes down to managing those companies, the same traits always apply. You know, there's people who get passionate about growing things. They're aggressive. They like to go out there and do a deal. That's what drives them. You know, they're the guys that you want to be pushing in certain areas of the company. When the company gets to another level, you know, you need to understand that the best thing for those people, and they need to understand the best things for themselves, is to then continue in that vein, maybe somewhere else, like growing another area of that company or whatever it might be, or maybe even, you know, move on to the next. I mean, it's so sad. I see so many people that are kind of looking for this big win. You know, they stick with these companies for like 10, 15 years, looking for this $1 billion win. And I try to tell these people sometimes, look, be successful small first time, because everyone wants to be involved with the successful person. And that gives you that ability then to have a secondary and third opportunities. So I think, you know, flexibility is really important, self-awareness for me. I don't want to change for anything what other people have said, because I think I agree with all of that. But you have to be self-aware, be accepting of who you are and what really gives you that passion. Because I see so many companies, so many people that we advise that go through that kind of 10-year phase, and they're like, why are we still doing this? They're trying to come up with like corporate strategies, re-engineering who they are, what our new ethos is. And it's because they've lost their way. It's because the passion's gone. And, you know, really they need to move on to something else. And because ultimately we are what we are because of what we do. You know, we need to keep that passion in ourselves. Take the business out of it for a minute, take the money out of it. If you're passionate about anything you do, you will be successful. And then the money comes. Money is just a side effect of the effort and who you are. You know, if anything, I would give anybody advice is be passionate in everything you do. And if that happens to be a money-making enterprise, then you will be successful. But be self-aware, guys. You know, it's really important that people find time to spend time with themselves and understand who they are, and then be true to that.
Great. Thank you for that. And thanks, self-awareness and flexibility, I guess. Yeah. So thanks for that, David. Sonny?
Thank you, Nathaniel. Thanks for asking those great questions. David, if I understand, again, coming from all of you, it's about people, about team, passionate people. Once you move up the series, the rounds, it's about people more, even more. So thank you so much. I just want to start with John asking this question. As an investor into late stage startups, what would you prefer? And also one successful use case that you recently invested in or you're planning to invest in, between exit, as an investor exiting out of a startup, M&A, takeover, as Dr. Shrikant say, you would like to do that, or an IPO. Between the three, which would you prefer and why? And one successful use case of a recent investment. Please.
Sure. For I echo what Dr. Shrikant said about late stage investing, not just aiming for the IPO, but aiming also possibly a merger and acquisition scenario. And I think that obviously as an investor, I prefer an IPO, but I think that what's most important is to find the right exit for the startup. Is the right exit. And recently we had a conversation, we invested in a company that's quite early stage, but we've been thinking about the exit already. And actually it affects how they plan the strategy, even at Series A. Because if they were there's a difference between being an AI module that could be plugged into systems versus being a platform that could grow to millions of to serve millions of users. And I think that when founders they plot the chart their journeys, they have to think about the exit as well, and they have to plan accordingly. But for us, I think no matter the outcome, it's important to walk with the team and help them to find the right solution, to find the right exit, and overcome these challenges with them, just like what Dr. Shrikant said. And one of the recent, for example, we invested in Fiscal Note, and we did a convertible round at Series F last year, and now the valuation has more than doubled. And before they told us that it was going to be an IPO, and now because of SPAC, it could possibly be a SPAC or a different kind of exit. For me, it's about supporting the decision that the CEO makes and helping him to be informed about the markets so that he can make the best decision for the firm, for the employees, and for the investors.
Perfect example. Thank you, Johnson, for sharing that. Next time, Dr. Shrikant, same question, because you are a lawyer as well. You must have been involved with a lot of M&A activities as well. So for you, which one would you advise a startup founder exit? I mean, you as an investor exiting out M&A, like, acquisition, merger and acquisition, or an IPO, which route would you advise and why? And maybe one of the successful use case you can share, just like Johnson shared about a SPAC investment instead of an IPO.
I firmly believe that you have a lot to learn from the unsuccessful journeys that you've made, rather than successful journeys. So I would rather give you an unsuccessful journey of a particular startup, which was in the medtech sector as such, and it was capitalizing on the COVID scenario and so on and so forth. So they were coming to us for a Series C, and it was a very large round. So I happen to be the person who kind of turned down the investment for reasons because of the fact that they can't go for, and they don't have a clear exit route as such. So that was a learning for me. So if you ask me a question, which one is the best of the options, I would say any option which gives me the bang, or me/the family, the best bang for the buck. It could be immediate, it could be 3 years down the line, it could be 5 years down the line. I think a lot of legal experts put a barrier to a startup by saying that after 5 years you need to do an IPO. After 5 years, by mandating a company to do an IPO may not be the right strategy. After 5 years, it is to be seen after 5 years what happens, right? So I don't think that's a very prudent strategy. A good strategy would be to leave and let the promoters make or create the value that prompted you to make that particular investment in the first place, right? So that is something that I would suggest, or I would endeavor for my startups.
Okay. Perfect example of an unsuccessful, and why wouldn't an investor be investing into it? I mean, it's always best to know both set of the stories, successful and unsuccessful, so that we can learn from our mistakes as well. Thank you so much, Dr. Shrikant, for sharing that example with us. Next, I have Gary. Gary, obviously, you have IPO'd many, exited out of many. But if you were to advise a founder who is planning to, in that route, which is the best route for as per you, exiting out, acquisition, like getting acquired by a bigger startup or a bigger company, or an IPO?
Well, I mean, I remember I'm a country boy, so how much are they going to offer and when are they going to do it? It's like really simple. And I've dealt with corporate development folks. I've only done one IPO in Nasdaq, but I can tell you directly, having been involved in numerous M&A activities, that it's about finding the right kind of fit. And, there's what happens, so we're in Silicon Valley. I have an office in Menlo Park. I talk to a lot of the corp dev people all the time. Many of the founders of some of Mark Benioff is a fraternity brother, and Teak with me. So we know a lot. We have a pretty broad access. But again, it's simple. How much money, and has the buzz been created? When buzz is created and the corp dev people start to talk, you can get offers that are through the roof, right? If you've positioned your company the right way. And especially today, you know, the pandemic has offered certain challenges. How do you build the trust? How do you get the word out? How do you establish yourself as an industry expert worldwide? So it's a different type of challenge than we had a year and a half ago. And so we've got to understand that it's not all about, it is about the relationships, but at the same time, these family offices and investors have mandates of what they need to do and at what point in time. So we need to make sure that we get that kind of visibility, like on VCTV, right? This is a perfect platform. This platform is perfect to be able to get the word out, to be able to get the startups so they get the visibility. And guess what? The corporate dev people do watch because I get contacted by them. So what we have to do is we have to build the story. It's about storytelling. The most successful entrepreneurs, and I actually had the pleasure of going to Stanford University and taking a couple of interesting courses in their continuing ed program. And it was about speaking as a startup founder and coached by an actor and also someone from the business school. Those skills are critically important because when you're in front of a group, having the passion and being able to convey it and the trust and enchantment are three pieces that are important to be able to get the right kind of valuation. Of course, you have to have financials to back it up. You have to have an exit strategy, but also you have to have the storytelling capabilities to get the word out. So it's, from my standpoint, I don't care what kind of, it's a SPAC, and I've written about those. If it's an IPO or it's an acquisition, you know, it may be the right time when it's a time when the buzz is created and it's like fishing and there's a lot of fish, you fish, right?
Absolutely.
So that's what you know, from my perspective. But buzz is really important. I strongly suggest to all the startup founders. I write a lot. I write 3 to 5 articles a week. I'm on shows, Forbes, books, you know, you name it. Those kind of things are important. So people can Google your name and figure out who you are by other people talking about you. So that's important for them. It helps build the trust.
Fantastic. Thank you. Thank you, Gary, for sharing those lovely points for the startups. David, same question for you as well.
Yeah, I mean, we kind of pivoted there, but I really appreciate that from Gary. I mean, for me, it's kind of it's definitely about timing. So it's the same thing. I guess Gary said buzz, but yeah, I mean, you got to listen to the people around you, and you build that relationship. You understand who is the movers and shakers, the opportunity getters, and you know, again, I don't really care where it pivots. I mean, I'm in the crypto ecosystem. I mean, the traditional space, I'm wherever the buzz is. You know, 3 years ago, it was the cannabis sector, and you lost money if you're a fool. It was impossible to lose money back then. You know, timing's everything. You know, a year ago, Bitcoin was going through a bear market, you know, and I was telling everybody, including myself, that this is the time to build, this is the time to invest. Everyone was saying no. I'm now making a lot more money because I understand about timing, and that comes from experience. You know, it's risk taking too, but at the same time, you know, if you're doing what you know everybody here is doing, which is building the risk relationships, it's figuring out who knows what. You know, I mean, there is such an obvious. It's who you know, not so much what you know, because through who you know, you get to find out all those things anyway. So it's a double-edged winning sword. And for me, you know, I learned more from my losses. I had a really, really impactful life experience when I was a young fund manager where I thought I was untouchable. And I got greedy, and I kind of took away some of those basic principles, you know, which was about, you know, creating sensible money management and investment structure, really. And yeah, I changed away from that, and I kind of put my money into something that I thought was an absolute winner. That couldn't, you know, it was backed by the government. It was had a $100 million grant. Everything was perfect. And then a rule change or a government body changed, and there was a environmental issue, and the whole thing got shut down.
When was
this? So this was with a company in Australia called, well, I won't mention the name, but they were focused on underground coal gasification, which, if you don't know, it's where you drill down into coal beds, and you have a factory on top, and it takes the gases, and you can create energy from that. And at the time, they did a pre-IPO and then a follow-up IPO, number of different rounds with warrants and everything like that. And I put a lot of money into that, and the whole operation got shut down. And I was confident that it was going to be a no-brainer because the government were behind it. They did this huge grant, you know, and the local area was for it because they were employing a number of different local people. So, you know, on the surface, it was perfect, right? And the deal was amazing, you know. So this goes back to how good is the deal. You know, if I'm getting into a seed round and they know that like there's going to be 3 or 4 further rounds, and then big funds have already agreed to come in, you know, at like maybe 10 or 20 times the valuation, that's a deal you don't pass up, right? And because you only have to deal with 2 or 3 of those, you know, 7 of those could fail out of 10, but those 3 will make you so much money you can afford those failures. So it's about, you know, it's about that. It's about making sure that when the opportunity comes, you understand the opportunity for what it is, you know, find those relationships, you know, travel. I mean, it's so important that you get out there when you can. I mean, it's tough right now, but, you know, we're all benefiting from the fact that we've done that hard work before now, right? The relationships are there that we can forge on those. You've had those experiences. So for me, it doesn't really matter what the deal is. I mean, I'm sat on a deal right now that I invested in called the Graph in the crypto space. You know, huge backers, huge amounts of money. You know, that was under 1 cent deal, and now it's trading at 60 cents. So if you can get those deals, if you know where to look, and timing is pretty much everything.
So yeah, David, just a question out of curiosity, and we're also running out of time. So what lessons did you learn from that failure, that the deal that looked backed by the government, the Australian deal looked very right on the surface and backed by the government? What was the lessons learned that you can share with this?
Well, there's 2 things. I mean, if you're going to fail young, because you have time to recover. So, I mean, that's important. But also it was really, I mean, I was taught a specific way, and I've done, you know, I did my MBA myself, and I'm not necessarily thinking that MBAs are perfect. I know Elon Musk's a big advocate of not doing MBAs because he thinks it creates sheep. But, you know, I'm a pretty entrepreneurial, you know, I'm pretty kind of contrarian type person. So I use that as an experience to kind of learn what other people were doing and taking advantage of other people thinking the same way. But for me, the lesson I learned was, it's okay to fail. It's okay to take risks. You know, if you fail, that you know, you're only failing if you don't try again. Otherwise, it's a life lesson. So for me, it was kind of like a resetting in my mind of, okay, I'm not going to be a billionaire in the next 2 weeks, on the next couple of months, or you know, before I was 30. But what it taught me was, okay, you can fail, but keep going. Just maybe don't put too much money into the one deal. You know, that was kind of the lesson from that.
Absolutely. Very quickly, on the last question, many crypto blockchain startups are very new. So, but Coinbase is planning to do an IPO, right? Is that correct?
Yeah.
So so as an investor, like, you know, you learned your lesson from a government-backed, obviously startup that sort of didn't make to an IPO and you lost money. So would you bet on a crypto exchange, which is going to be an IPO? Like, just sharing your insights.
Coinbase is a no-brainer for me. It's the first major exchange. They're revenue producing. They've got government backing in terms of licensing. You know, they're too big to fail. If they ever got into trouble with the SEC, they'd do a deal. Ultimately, the SEC, you know, they're looking to create revenues from taxes. So, you know, they're not gonna shut these people down. It's about finding a way. So yeah, absolutely. And that's why we're focused on taking some of the best people out there. I mean, Gary mentioned AI, so I'm working with Singularity Net, Ben, who's a big AI guy from Silicon Valley himself. Maybe Gary knows him, I don't know. But the point is, those types of people, those types of characters, the traditional space is crying out for that. I mean, my gut feel is there'll probably be a new index they'll create, which will kind of be like middle ground between the two. So, yeah, this for me is going to be a feature of the next couple of years where you'll see more of these traditional type of people coming into the crypto space and taking them to a more public setting.
Fantastic. Thank you so much, David, for those insights. I'll come to the end of the show. Johnson, closing remarks and your feedback. This is your first time on VCTV, and I'm really going to have you back on VCTV. But before that, I would like to know your feedback as well.
Yeah, thank you again for having me. I think this is a great platform. I learned so much from our fellow panelists and speakers. I think that it's again, to echo the sentiments, it's really important to go on these, go on the token and be present and sort of so people get to know you and to share insights and to give back. I think one of the things, if investors were watching, I would say that late stage, there's a lot of hype right now because of where the market is, because the market is very hot for tech stocks. And I think a lot of people think that these IPO or pre-IPO late stage investing deals are sure wins. I want to say that there is nothing is guaranteed. There's no sure wins, and you have to find the right startup that works for you for the right risk profile. And I think that always invest in great entrepreneurs and great business models. So I'm very grateful to be on this panel, and I would love to help out in any way I can in the future.
Thank you so much. Thank you. Thank you so much. Dr. Shrikant, over to you, please.
No, I would echo the thoughts that John raised. Late stage investing, there's a lot of good deals out there. I think you can't be digging for oil and if you hit upon gold, can't be complaining. So if you find water, that is a different issue altogether. So I think investors need to be very clear about what they are searching for. If they're searching for gold and they hit upon oil, make the best of it. But if you hit upon water, then make the best of that as well. Or if you hit upon a rock, good luck.
Thank you so much. And obviously, we look forward to have you back on VCTV. Thank you so much. Gary, over to you, please.
Yeah, so as I said, AI is the new electricity, and this is a great opportunity to invest in those companies. Late stage, I mean, from my perspective, we curate them through early stage, and those are the companies that are moving forward. But look at today, data is around us. I'm looking for companies that take data and use semi-supervised and unsupervised AI to do incredible things. I've been on panels recently with drug discovery groups, top pharmaceutical companies in Europe. They're using artificial intelligence to be able to do modeling so they don't have to spend so much bench time. Those are really important. Of course, Yva, my company, the unicorn, is a work tech. We did remote workforce management 2 years ago. So there's look at it. So whether it's space travel, whether it's manufacturing or healthcare, data is critically important. But it's not just aggregating the data, the decisions that are made with the data, and then moving from some semi-supervised to unsupervised, which means the system makes decisions for you. So that's really where we are. And also, I'm writing a lot about quantum computing and quantum networks. It is coming into being, and I'm fascinated by it. When you find systems that are 100 million times faster than supercomputers that can make decisions that would take 10,000 years in 200 seconds, that's incredible. So what I'm looking for is bold, resilient teams that are moving into those areas that are going to change the way we live and change the amount of time we spend on this earth.
Fantastic. Thank you, Gary, for those lovely closing remarks. Next, I have David. This is your first time on VCTV. Your feedback is much appreciated. Thank you.
Yeah, I just want to thank you all for having me. Again, I've learned a lot from other people on this panel. I've enjoyed it, actually. Again, it kind of just goes to show, these events are really important because you get to feel and hear from different people. you resonate to different people's ideas and concepts. And I think, that's what humanity is all about, really. It's about being aligned with different people, feeling into what they're saying and resonating to that. So, I'll take a lot of, positives from this. Hopefully reach out to a few of these guys too, because I think there's some possibility of collaboration, definitely.
Absolutely.
And just to finish off, I think if you're an investor right now, I think you should always have some sort of strategy. If you're thinking about, how you could get involved in the investment space, I would definitely encourage you to research and spend a lot of time doing that. Pretty much everybody here, I would imagine, has a pretty in-depth team of researchers and analysts. It's really important that you understand what kind is happening. And really, I'm focused more really on the investment side of things. So I kind of already know what's happening, because I got guys in the back of my ear going, hey, can I get involved in this? Or can I do that? And, and that kind of gives you an idea. But the real tech, the real development is like 2 years in front, so you already kind of have a sense of what's likely to come, because, these test and dev kind of guys, they're deep doing this stuff, and the question is, what are they doing now? So I'd ask yourself, what's really going to be big in the future, and we can see a lot of that stuff. So, automation, AI, obviously, as Gary's mentioned, is really big. We're in COVID. So what's going to be big post-COVID? And just to finish, 2008 was obviously the big bad year for a lot of businesses and economies. I think, and don't quote me exactly, but I think the average startup success in an annual year is between 20 and 30%. So, 2009 was around 70 to 80%. And so what does that tell you? It basically means that when times get tough, opportunity comes. And so I think I would say to everybody right now to be really, really on the out, looking on for opportunities, really be searching about what is going to be successful and what has been successful in this type of environment. Because if you can be successful and create revenues in an environment like this, then you're more likely to be successful in an environment where opportunities are more abundant. So yeah, that's how I believe that. And thank you again for having me.
That every crisis brings opportunity, rightly said, David. And thank you so much, all of you, for your time today. Startups, entrepreneurs, founders who are watching us today, feel free to reach out to us, and we are here to connect you to the investors. Similarly, as David said, he's looking forward to collaborate with other investors who like to share the space and share the insights, success story, unsuccessful stories. Please feel free to reach out to us. I'll be back tomorrow with another topic, another set of speakers. Till then, keep watching PCTV. Take care of yourself and have a good day. Thank you.
Bye-bye.
Bye.
Bye, guys.
Bye.
Bye.